Russia's oil and gas revenues have collapsed to levels not seen in over 5 years, squeezed by Western sanctions, weaker global prices and even stronger Russian ruble. This shortfall is straining Moscow's budget and could have ripple effects on the global energy landscape. Russia's state income from oil and gas, a cornerstone of its economy, has dropped sharply, as I mentioned. In January this year, revenues from oil and gas taxes fell by about 50% compared with the same month just last year, hitting roughly 93 billion rubles, around $5.1 billion, the lowest since mid-2020. That collapse comes as benchmark prices for Russia's main crude grade have slumped, and international sanctions force bigger discounts on Russian barrels. So what's driving this tumble in oil income? Russia's Urals trade and related blends have traded significantly below previous levels, dragging down tax income on exports. A stronger currency means each dollar of export revenue converts into fewer rubles, shrinking income in local terms. Sanctions targeting major producers have widened the gap between Russian oil and international benchmarks, forcing bigger price cuts to maintain buyers. And this isn't just about January. The broader picture for last year, it looks grim. For the full year 2025, Russia's oil and gas revenues plunged about 24%, down to roughly 8.48 trillion rubles, and that is $108 billion, the lowest annual intake since 2020's pandemic slump. Even before this year's results were tallied, monthly figures showed steep declines. In October, oil and gas tax receipts were down roughly 27% from the prior year, and prices for Russian crude fell into the low $30 per barrel. Analysts warned the plunge in energy money could nearly triple Russia's budget deficit beyond official targets this year, with forecasts projecting energy revenue down about 18% below expectations, pushing the deficit to over 3.5 to 4.4% of the GDP instead of the planned 1.6%. Oil and gas still make up roughly a quarter of federal revenues, funding defense and government programs, meaning continued weakness in the sector could force deeper spending cuts or increased borrowing.